Bismillahirrahmanirrahim. Assalamu alaikum. Viewers, you are welcome in this video. This video is a continuation of my previous three videos on a topic, ratio analysis. In my first three videos, I have covered liquidity, solvency, and profitability categories of ratio analysis. In this video, I will cover discussion on efficiency ratios. You can find the links of all previous three videos in the description if you want to have a look at the previous videos so you can easily access them. So let's start our discussion on efficiency ratios. Viewers, efficiency ratios measure how well the business is using its assets and liabilities to generate sales and earn profit. They calculate the use of inventory, machinery utilization, turnover of liabilities, as well as the usage of equity. These ratios are important because when there is an improvement in the efficiency ratios, the business stands to generate more revenues and profits. Some of the important efficiency ratios include the asset turnover, inventory turnover, payable turnover, fixed asset turnover, and receivable turnover ratio. We will discuss all these ratios one after the other. So the first one is asset turnover ratio. When we talk about asset turnover ratio, it is also known as the total asset turnover ratio. It measures the efficiency with which a company uses its assets to produce sales. The asset turnover ratio formula is equal to net sales divided by the total or average assets of a company. A company with a high asset turnover ratio operates more efficiently as compared to competitors with a low ratio. In this formula, the net sales refers to amount of revenue generated after deducting sales returns, sales discounts, and sales allowances. Also, average total assets refers to average of aggregate assets at year end of the current or preceding fiscal year. One point one should note that sometimes analysts may use either average or end of period assets. If you look at the example of asset turnover ratio, let's have a look that company A reported beginning total assets of $199,500 and ending total assets of $199,203 over the same period. The company generated sales of $325,300 with sales returns of $15,000. Viewers, as you can see in the formula, that sales returns are subtracted from the sales figures and then they are divided by the average assets. So average assets mean that 199,500, which is a beginning total, and 199,203, which is an ending total. The sum of these two values we have divided by 2 to get an average, and finally we will get an answer 1.5565. Now, if we look at the interpretation, so the interpretation is that for every dollar in total assets, company A generated $1.5565 in sales. The next ratio is debtors collection period. This ratio shows how long the average credit customer took to pay their invoice. The figure is expressed in days. The quicker a company can collect its money from its debtors, then this improves the working capital management, particularly cash flow of the company. If the company is having difficulty in getting money in, then this could lead to cash flow problems and the company may not be able to settle its own debts on time. Debtors collection period can be calculated by dividing debtors divided by net credit sales multiplied by 365. Here, let's assume that we have debtors 12,000. We need to divide it by net credit sales. Assume that we are having 150,000 and then multiply by 365. The answer comes 29.2 days. Means that on average the company is taking 29 days to collect its cash from its credit customers. The next one is creditors payment period. Creditors payment period. This ratio shows how quickly a company pays its own creditors. Creditors are often seen as a good source of free short-term cash, and while this is true, care should be taken not to strain an otherwise healthy trading relationship. A sound working capital management policy would be to collect money in faster from the debtors than it takes the company to repay its creditors. If the company is paying its creditors more quickly than it receives money from the debtors, then this could cause cash flow difficulties. The bottom line is that we need to compare creditors payment period in relation to debtors collection period. So debtor collection should be less as compared to creditors payment period. In the previous slide, I have shown you debtors collection, it was 29, and you can see the formula creditors payment period equals creditors divided by net credit purchases multiplied by 365. Let's assume that we have creditors 9,000, net credit purchases 80,000 multiplied by 365. So this gives us 41 days, meaning on average company is taking 41 days to repay to its creditors, which is higher than creditors debtors collection period. The next is inventory turnover ratio. Inventory turnover ratio is an efficiency ratio that shows how effectively inventory is managed by comparing cost of goods sold with average inventory for a period. This measures how many times average inventory is turned or sold during a period. In other words, it measures how many times a company sold its total average inventory amount during the year. A company with $1,000 of average inventory and sales of $10,000 effectively sold its inventory 10 times over. The formula is inventory turnover ratio is cost of goods sold divided by average inventory. So it comes in terms of times. Higher the ratio, better will be the company's efficiency. The last ratio in this category is fixed asset turnover. Fixed asset turnover is an efficiency ratio that indicates how well or efficiently a business uses fixed assets to generate sales. This ratio divides net sales by net fixed assets, calculated over an annual period. The net fixed assets include the amount of property, plant and equipment, less the accumulated depreciation. Generally, a higher fixed asset ratio implies more effective utilization of investments in fixed assets to generate revenue. This ratio is often analyzed alongside leverage and profitability ratios. Here it comes the formula of fixed asset turnover. You can see that we need to divide net sales by average fixed assets. Let's have a look at the example. Fisher Company has annual gross sales of $10 million in the year 2021 with sales returns and allowances of $10,000. Its net fixed assets beginning balance was $1 million while the year-end balance amounts to $1.1 million. So based on the given figures, the fixed asset turnover ratio for the year is 9.51, meaning that for every $1 invested in fixed assets, a return of almost $10 is earned. The average net fixed asset figure is calculated by adding the beginning and ending balances, then dividing that number by 2. Viewers, that's the end of discussion regarding efficiency ratios. Thank you for watching. Do subscribe to Financial Specialist channel by clicking on subscribe button and hit the bell icon so that you will get the intimation of upcoming videos. My next video, it will be on coverage ratio, which will be a video number 5, and the sixth and last video I will cover the last category of ratios called market prospects related ratios. So thank you very much, and thanks for watching. See you in the next video.